Hello, Smart Money Street Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagerin. Hey, Doug.
For those of you who've never seen me before, welcome to the first time because it's good to be back again, Kirk.
And those of you who are not watching me, I am currently wearing a tinfoil hat. You want to ask me why, Doug?
Because there is a number of tinfoil rallies, but I'm gonna reasons, but I'm gonna let you tell everybody why.
There's a big reason, Doug, and the letters are UFO. As of 8 o'clock this morning, the government, I think it's war.gov/UFO, dumped a bunch of UFO files on their government website, and I only heard about this in passing. Like, it's not taking off like you'd expect, probably because it came out at 8 a.m. when no one was paying attention. But it's starting to pick up. And my guess is, well, the war is probably not going as planned. So let's dump out a bunch of UFO files on there and get people talking about that, so they're not talking about the war.
Or Epstein, you know.
But no. That's next. That's if they get tired of the UFO files, they can dump more Epstein files. Oh, we got some more information on JFK.
Well, now the JFK bullet will go in reverse. So
all I know is I haven't read these. I literally saw this pop up on X like a half hour ago, and I just saw the website, and it looks like there's 17 pages of stuff, which to me looks like absolutely nothing compared to since, what was it, 1950 or 52 or whenever the Roswell thing happened. We've got 75 years of stuff, and hey, we only got 17 documents. Like, okay, sure.
We're still celebrating Roswell. Somehow I don't see this having the same impact Roswell did. But the thing, Kirk, that makes me laugh the most is it's not the fact that we're talking, whether or not aliens exist or not. It's which of course is some of what people are reading into it. But the bigger one for me is the people that are like going, this has got to be fake. These are fake UFOs. I'm like, UFO does not mean alien, people. It just means they don't know what it is.
So I'm gonna use this as an opportunity not to turn this into a tinfoil hat show. Those of you watching see I'm still wearing it. I don't want to turn this into a tinfoil hat show and an alien show. I think it's fascinating that they're dropping this, but let me give you some frameworks on how to think about things, and I'll try to pivot this into the stock market. Okay. Now, I'm going to lay this out because some people don't know anything about aliens or don't care. I've been fascinated with this stuff since I was a kid. It's just always been interesting to me. But so let's think about this big picture. Okay. People think that there's aliens, that they've seen evidence and craft and videos and all this stuff over the last 75 years. Okay.
And
since the internet has gotten bigger, people are sharing stuff more and more, and of course, it's easier to fake stuff. Anyway, so it's taken off, and of course, for the last 12 months, I think government officials have been talking about disclosure. They've been talking about, well, we need disclosure. We need to talk about it. Which, giving people amnesty for disclosure is like saying, yeah, we stole $1 billion, but if you give me amnesty, I'll give you this one file. No, you're going to jail, buddy, right? But whatever. So that is what it is. So they've been talking about it. They've been grooming the public that this is coming out for like 12 months. They've been grooming the public about this. And then recently, slowly and more slowly, things have come up, or more quickly. And now they have this big, information dump. Now, let's talk through how to think about, information that's disseminated from the government. Okay. So on the one side, you could say, wow, it's aliens and all this stuff's coming out. Well, it says UFO. It doesn't say aliens. And I haven't looked through it, but I'm pretty sure they don't have pictures of aliens in there. They probably just have, videos of saucers or whatever that they've captured from like the military aircraft. That's my guess. I haven't seen it, but I'm going to speculate. It's a whole lot of nothing. There's some videos that we've already seen, and they're quote unquote releasing it. Okay. Let's say they release more. Now, you could say aliens exist, and there's this other thing. Who knows if they're from Mars or another dimension or whatever, whatever the thing is. I don't even know. But let's say it exists. Okay. Do I believe the fact the government's releasing it now after 75 years? Heck no. I don't know if what they're releasing is true or not. Right. So you could say, well, they're releasing it's great. Well, they lied to you for 75 years, and they've apparently, people have, I'm not going to get myself arrested here, but people have claimed that scientists have gotten killed, the scientists that are around this area and talking about this, and they've claimed they've been killed, or they've died, but whatever, whistleblowers and whatever, they've kind of disappeared. So you've got all this stuff going on, right? And now they're releasing it. Now I'm supposed to believe the government, and people generally don't believe the government in their area of choice. Well, I believe them on this area, but not in this area. Yeah, they're lying to you all. They're lying to you on every area. So do I believe them on this? No. I don't know if this is a psyop, if they're doing it because they're trying to do something else, or if they're really legitimately releasing this. I have no idea. So my point of all this is to use this as a thought experiment to think, to understand how to think, right? The government releases something. I don't know if it's true. I don't know if it's made up. I don't know if it's the whole story. I don't know if it's a psyop. I don't know any of this. So I look at it and say, isn't that interesting? It's interesting. They released the JFK files. They released the files on Epstein. Isn't that interesting? How do I know it's not all the files? Maybe it is, maybe it's not. Maybe they're redacting important information. I don't know enough to make a decision of whether things are true or not, right? I'm just a normal citizen. I don't have any inside information. So if you look at situations like this, you can say, okay, this is a start, but there's probably a whole heck of a lot more they're not releasing. Now, do I expect them to release everything? No. If they've got some flying craft, do you think they're going to release it so China and Russia can copy it? Of course not. So, when you see stuff like this, you have to ask yourself, why are they releasing it? Why are they doing it now? My guess is because the war is probably not going as planned and they're trying to use it as distraction. Trump has talked about releasing this for 10 years. So I'm not surprised he released it. But the timing is really interesting because the war was quote unquote over a few weeks ago, but yet I'm still hearing news about missiles getting fired. And I think Trump just sent out a Truth Social thing yesterday about, taking down some Iran small boat with 3 destroyers, and there was no damage, but there were he just basically taunting them. I'm like, wait, I thought there was a ceasefire. And yet we're bombing and destroying stuff. Like, what's going on, right? And so my son, I told this to you guys a few weeks ago, my son asked me what's going on. I'm like, honestly, I don't know. I don't even know who you find out from. Because Trump's saying this, and of course, whether it's true or not, he said the war's over. I suspect it's probably not true. But the market seems to think it is. The market doesn't seem to care. Oil prices are still going up. And the stocks are not, well, I'm going to go over this in a bit. But stocks are not showing like they're completely convinced. So, the question you have to ask yourself, and this is, as a tinfoil hat guy, I've got this tinfoil hat. I love it. I love thinking about things outside the box, and UFOs are certainly one of those things. But I don't know if it's true. I don't really care. It's not going to keep me up at night. I'm not going to spin my wheels if they're lying to me. I just think it's interesting. It's like reading a sci-fi novel. Like, hey, cool. But I will say that the amount of stuff being disseminated from the government right now about it gives me pause to say, okay, what's really going on here? And I'm not sure that I'm going to believe anything anybody says at this moment, but I'm just going to keep an eye on it and say, okay, that's interesting. Now, oddly enough, as I was watching the market today, I noticed there's an ETF with the symbol UFO, and I think it's based on basically outer space kind of companies like satellites and things like that. And it's up like 4.5% today. I don't know if it's because of the release or not, but I just think it's really funny that out of everything that's up, it's one of the top performing ETFs today.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here. See? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
Anyway, I don't know. What are your thoughts, Doug? I know you don't have a tinfoil hat, so I'll keep mine on, but what are your thoughts?
You know, I haven't gone forward and manufactured my own tinfoil hat, Kirk. I need to do that at some point.
You do.
Yeah, because there's too many things right now that that the powers that be are sucking away from my brain activity, and I really need to make sure that 5G doesn't enter. Yeah.
Need a Faraday cage, Doug.
What was that?
Need a Faraday cage, so none of your electronics work outside of the Faraday cage. You're isolated.
You know what? I just need to sit out on my screened-in porch more often, right? Is because they're if you think about it, your screened-in porch, if you're lucky enough to have one on your house, it's nobody really thinks this way, but it was a unintended Faraday cage for people to be able to go out, enjoy nature, but also make sure that you're protected from from the NSA and whoever else is listening. Yeah, when it comes to the announcement, I mean, I think everybody can agree right now that you just got to stop listening to the noise. I mean, new things getting released. I saw a joke on the with regards to the releasing of the UFO stuff before it got released today, and somebody basically parodied it to Epstein, like, here's what it's going to look like, and it was just a single page with everything blacked out, right? It's like, here you go, we've released it with nothing. And it just reminds me of the movie Good Morning Vietnam, right? When everything's coming off the printers, and he's got the two guys in the other room, the twins that are just black, crossing off everything until Adrian Cronauer decides screw it. He's just going to run in, grab it right off the printer, and start just saying it as it is, bypassing the censors. Until somebody is willing to do that, which, by the way, will be a never, we're not going to get anything that's going to be of any material substance. And let's take this back to the financial world. It's the same thing with data. I haven't had a chance to disseminate it, but the jobs report just came out, and the jobs report was terrible. And I feel like we're at the opposite of where we were 4 years ago, when the jobs data was always great until they came back later and said it sucked. Now we're seeing jobs data that's terrible, and who knows if they're going to now come back and, as we get close to the midterms, say, look, guess what? Forget what we said. It's wonderful. And, everything is good. Just watch this hand, not this hand. The markets we just got some new data that came out that says, showing consumer sentiment is at, basically at all-time lows, offsetting the fact that the markets are at all-time highs. Now, and of course you'll hear things that are telling you it's at the all-time highs, run for the hills. The reality is whether or not the markets are at all-time highs, or they're at all-time lows, or somewhere in the middle. The reality is that markets can go up and they can go down from there. When and why that's going to happen is certainly something that, unfortunately, the reality is, those listening, you'll be the last to know. We're in a computerized trading world where things go faster. I think most people would feel pretty confident right now that some of the moves that have been made in the market have been eerily too close to when decisions of news have come out, but they always seem to be in front of it. So, for those that are sitting there trying to continue to live on a world of efficient market theory, which effectively, the definition of that is that everybody out there making an investment decision is being able to make that investment decision with the same information everybody else has. My personal opinion, if you're still following that event, if giving that any credibility, you're probably living under a tinfoil hat, because it is clearly evident that people have information that other people don't have access to it, whether or not that is malicious and truly insider trading type of situations, or whether or not it's just the fact that some people have access to conversations that other people don't have. So from that standpoint, you got to really do your own research and look at things a little bit more closely. We also got some new data that coming out in the tech world that I thought was really interesting. Is they're projecting, that the amount of concentration of investment in AI is really in a handful of about 5 different companies. You know who those companies are already. Google, Meta, is certainly in it, but forward-looking free cash flow for all of those companies is, they're draining and hemorrhaging cash left and right. Now, some people would look at that as extremely bearish going into the future. Say, "Oh gosh, look at them; they're basically imploding." But this has kind of been their mantra going all the way back to the 90s. And Kirk, I think you had someone on probably with, the time frame might be a year or two ago, but someone that talked about how if you take a look at in venture capital and investment money, it has typically not gone to the areas where there's a safe and obvious return. It's not gone to gone to the investment of things that have, already a profitable return, already a dividend return. Where does it go? It goes to speculation. It goes to where there is this perceived opportunity for multiple X return. And there still seems to be in the world of Silicon Valley an extremely optimistic and heavy dose of investment that's going towards AI. There is going to be, they're not letting up the gas on that. Now, does that mean that that's going to be, if their track record shows us from the past, that means that we're going to see an opportunity where absolutely where that money is going is going to turn out to be, a significant return on investment? Hard to say. We saw, this could be the time in which that investment starts to evolve into something that doesn't have that return. It's very, kind of looking at it as, yes, they've got the information. Yes, they've got the money. Yes, they've got the positioning, but also there's a little bit of, the word I'm looking for, ideology there. And when you start to get, in a world where you've been successful and you start to get ideological, then you can start to sometimes cloud the judgment on what is actually going to be an effective outcome. And, it's very hard. Very few people out there, or very few entities out there, have a Midas touch. And and it's very hard to repeat lightning in a bottle. Right. And those companies absolutely hit lightning in the bottle. If you look at all of the companies that came out of the 90s, and how few of them made it, you look at how long Amazon or Tesla and those companies were hemorrhaging cash to get to where they are today. And they were able to make it, but a lot of roadkill along the way. Question is, are they able to take what they have and the resources they have and hit lightning twice with the future of AI? That's going to be a big question. And that is where the markets right now are teetering heavily on the outcome of AI. And if we see, and we know this going into midterms, we know this with the markets, they're impatient. So how long can that patience hold? And if it can hold and we start to see some things come back positive, it could be a tremendous catalyst for the markets to continue to go successfully forward. But if we don't see that, I think that, to me, is part of what holds up whether or not the rest of this year ends up being extremely volatile into next year, because we already know that we're seeing the consumer get squeezed on gas prices, on other areas of inflation. We're starting to feel a little bit more of the impact. Again, we said this a month or so ago, there was going to be a lag from Iran. That lag is here. We saw gas prices spike 30, 40, 50 cents across the nation over an average of $4, where we had been at $2.50 50 cents average for a while. So we're starting to feel that. They're going to need some good news to hit. Otherwise, going into the midterms, that normal volatility we see could start to pick up over the next quarters. And that, to me, is something we need to watch very closely.
Yeah, I couldn't agree more. So I'm going to share what I want to share today is there's a handful of charts I want to share that I pulled up this morning. So the markets have changed a little bit today, but basically these are some charts I shared this morning, and they're about 12-month, about a 12-month chart, and I'm going to start with each sector of the S&P 500. So this is a little education on how to think about investing. So the S&P 500 is a broad-based index. Okay, the Nasdaq is also a relatively broad-based index, and so is the Dow. Okay, those are three major indexes we look at for large cap stocks in the US. Then you have like the Russell 2000 for small caps, and you have other ones. But basically, those three, the Dow is probably the least relevant because there's only 30 stocks, and they are price weighted. So if a company's $500 a share, it's going to be much bigger weight. I think Goldman Sachs is the biggest weight because they have the highest price. Which isn't, it's not the biggest company, but in terms of price, they give the biggest weight. So nobody I know uses the Dow, but I know a lot of people talk about it on the news because it has the highest number. So they're like, oh, wow, it's like 100,000. Like, I don't know what it is today because I don't even look at it. But, a lot of people look at it because it's a big number. I don't really care about it. The S&P 500 is the most common one that people look at, okay? The S&P 500 is split up. There's allocation percentages for each sector. Okay, each sector, there's, I think, 11 or 12 sectors, and I think there's 11 sectors. Each one has a percentage of the whole index. The NASDAQ has a less diversified version. I think they have zero energy, and I think there's some others that they have zero, but they have a big tech weighting. So a lot of people like the NASDAQ because there's a big tech weighting. Now, for the S&P 500, information technology sector is about 30% of the index, is the biggest by far, okay? So this first chart is industrials. These would be things like airlines or like Caterpillar, companies like that. So if you see here, it did really well up until the war started, and then it went down, and then went back up. But it still is not at all-time highs. Okay, it's still about 2-3% off the highs. Hasn't broke out from the high we had in February. Okay, just keep that in mind. The next one is energy. Now you can see obviously energy did really well this year, especially with the war. But since the war is quote unquote over or ceasefire, the energy sector's come down a lot. Now keep in mind the energy sector is about 3%, maybe it's 4% now with the big rise of the whole index. So it's a very small percentage, but it's obviously done well this year. But since the end of March, it's come down a lot. Okay, another thing to keep in mind. The next one is financials. Okay, financials are basically, they're down for the year. Large part because of the because of private credit. A lot of people have concerns there. It's probably not as much of a problem as it should be, but either way, you can see it's pretty much from the year. It's down for the year, and it's up from the low point, but it's really not taken off. Okay. And the next one is materials. These would be companies like mining companies, right, or chemical companies. It'd be materials. These are good for inflation, right? If commodities are taken off, these things tend to do well. Also, not at all-time highs. They came down with the war and came back, and they're not all-time highs. They're about maybe 8% off all-time highs. Okay. The next one is staples, consumer staples, right? These would be things like Johnson & Johnson, right? Or Walmart, or, companies, Costco, staples, things you use every day, things that, you can't do without. Well, you can see it did really well until the war, and it's come off, and it really hasn't come back. It's really underperforming. It's about 13-14% off the highs. So it really, there was like a point where it broke out this year, and then it's come back, and now it's just hanging around that point. So really not doing well, underperformer because of the war, in large part because these companies rely on transportation costs, which are going up, which means that their margins are shrinking. So there's an understanding of why they wouldn't do well. The next one is utilities, right? These are like your electrical station, right? Duke Power and all these power companies. They actually have done reasonably well. And if you see this chart, you're like, wow, these are actually doing better than I would have thought. But if you see since the war, they've really gone nowhere. Okay, they're not a big percentage. They're probably like 3 or 4% of the index. It's really not a big percent. But either way, they haven't gone anywhere. Okay, so far up to this point, we haven't seen a lot of progress. A lot of going sideways, bouncing around a lot, but not really doing a whole heck of a lot. The next one is healthcare. Holy crap, does that look ugly? Okay, high 160, now it's down to 144. Off the top of my head, what is that? About a 10%, more than 10%. Yeah, but a 10% drop. That's ugly. And it doesn't look like it's getting better, right? And this is healthcare companies, right? These would be like Eli Lilly and, Merck and Pfizer and companies like that, right? That's not doing very well at all. Okay. So we have a lot of sideways companies. We have a company that's really not doing well. And yet indexes are at all-time highs. What's going on? Well, here's the next one. Here's consumer discretionary. These would be things that you can decide whether to buy or not. It's not really a staple. It's kind of like a nice to have. It'd be like getting a Tiffany's bracelet, which you don't really need. So these tend to do well in certain parts of the market, but they haven't really done that well this year. I think they're pretty flat for the year, maybe down a little bit. Okay, so let's get to the most important one, the technology sector. Now, this chart is clearly at all-time highs. It's about 10% above the peak prior to the war. Actually, it was doing poorly until the end of the war. The whole year, it did basically nothing since September of last year. It just went sideways and dipped down. Now it's just taken off. Now, this is 30% of the index. And it's up 10%. Now, looking at all these charts, you might think, there's no way the index is up. Clearly not. It can't be based on all those charts, except for this one chart. Now, if you look at, I have to pull this up here. So if you look at the NASDAQ, it looks very much like the technology sector. NASDAQ's mostly technology. So there's a reason why it looks this way, okay? Really has gone sideways and has just totally taken off. So the NASDAQ looks good this year. It's up a decent amount so far. Here's the S&P 500, also up a lot. Wait a minute, why are these things up so much when clearly only one sector is up? And these things are up, I think the S&P is up like 5% from the peak. It's up like 15% from the low or something crazy. But the point being is, like, this is not, why does it look like this? This looks like the technology sector and not the rest of them. Now you've got the Dow. So the Dow's not even at all-time highs yet. 30 stocks. It's right around highs, but it's just below. So what's going on? What's going on with the Dow? It's not going anywhere, right? Now you got the small caps. Some small caps are doing well, which is a little different. I don't want to get caught in the weeds with the small caps, but small caps are doing well. And here's the equal weight. Okay, so if you take all of those sectors together that we talked about, right, and rather than weight them like the S&P 500 does, right, there's a heavy weighting to bigger companies in the S&P 500. Okay, so the biggest companies in the world get a bigger weight. So no matter what they do, the index pretty much follows. Now, if you take all 500 stocks and you weight them all 1/500th, so the smallest companies in the S&P are the same amount as Apple or Nvidia, okay, which are some of the largest. This shows me that the markets are not doing as well as you would think. Now, it's not terrible. It's right around all-time highs, but it's not a broad-based, awesomeness across the board. And so I show you this because it's really important to understand what's going on. And I'm going to share exactly, and this is the total market index, right? It also shows the same thing. But here's what I'm going to show you. I'm going to show you based on, the technology sector, which I don't think I have it here. the semiconductor sector looks a lot like this, and I don't know where it is. Let's see if I can find it. Oh, here's the Mag 7. So here are the Mag 7 that everybody's been investing in for like the last decade. It's barely at all-time highs, just like all the other indexes. Here's the semiconductor index. So it looks like it's up about ballparking about 50%, 40, 50% right now from the low this year. That is where all the returns are coming from. Now, if you look at, let's see if I can find it here. If maybe I won't find it. So what I want to really point out is that if you're looking at investing, you can't assume just because one thing's doing well that everything's doing well. You have to keep in context. Sorry, I'm trying to find this one thing and I can't find it. Well, anyway, so you want to keep in context that just because semiconductors are doing well, it doesn't mean everything else is, and it doesn't mean you should be in the market just because they're going up. Now, here is the software sector. The technology sector is made up of many different groups, okay? One of which is semiconductors, right? Which are clearly doing great this year. Another one is software, which also was a big part of the index. It's no longer as big. Semiconductors make up 17% of the S&P 500. 17% of just semiconductors, okay? Out of that 30, you've got software and you get some other things. You got hardware, but this is software. Software is ugly. If you're investing in software, you know, from the high to the low, you're down about 40%. I think you're up now. Maybe it's only down like 20%, 25%. But the point is there is clearly a divergence in the force. Okay. You have semiconductors going crazy, software is doing terrible, largely for the same reason, for AI. People don't trust software companies because they don't know what they're worth, they don't know what they're valued at. But you have one area of the markets doing so much better than everywhere else, and that's taking control of the direction of the markets. Now, the reason I show that is to help you understand why markets move as they move. That was just a breakdown of all the different sectors. Okay, that's a bunch of different sectors in the market, how they're doing. You know, you see the S&P up, the NASDAQ up. Oh my God, it's a bull market. We're missing out. No, you're not missing out. You're missing out on semiconductors. You might as well just throw money at that because that's going clearly to the moon. And I'm not saying to do this, is not advice. But I'm saying if you want to take like the dumb money approach, right? Like I don't know anything, I'm just going to put it all in black kind of approach, then semiconductors is the place to be. Everywhere else is just biding time. Now, put this into context for what else is going on in the world. We still have a war going on. We still don't know exactly what's going to come of it. There's a ceasefire, sort of, not really. And, you know, Trump's out there talking what he has to talk to, you know, to pour honey in our ears so we stop paying attention. And, you know, the market doesn't seem to care because the market's going all-time highs. The market thinks it's over. I would argue that we're probably closer to over than the beginning, but you have countries that can't get access to oil or energy, you know, heating oil, natural gas, oil. They don't have access to it because the Strait of Hormuz is closed. And for the last 8 weeks, no one's gotten anything. So what's going on in these countries? I would say, based on my calculations, I think we've got about a month, maybe 3 weeks, 3 to 4 weeks left before a lot of these countries' reserves. A lot of countries have reserves, kind of like we have a strategic reserve, which is basically like 2 days worth. But a lot of these countries have strategic reserves, and they're going to be out. Most of them will be out by the end of May. If that happens, and we don't have this wrapped up, I don't know what's going to happen, but it's not going to be pretty. Okay. Now, Trump could kind of claim it as a win and just say, all right, we're going to let everybody go home. But now you've got 2 to 3 months worth of oil that even if they started today, it's still going to take 8 weeks for other people. It's going to take 6 weeks. It's still going to take 6 weeks for people to get their stuff. So just because the war's once the blockade is over, once it's over, it doesn't mean that all of a sudden everything goes back to normal. So as of today, you're going to have 8 weeks of really bad earnings data. You're going to have high energy prices. The industrials, the airlines, the consumer staples are still going to have really tough earnings next quarter. I expect them to be bad. I don't know what that means for each stock price, but let's just say I wouldn't bet on them going to the moon. Okay. Now they'll go through it and people get over it and they'll move on. That's what happens with markets. But you should understand that based on what we're seeing, if this goes another month, it's not going to be pretty. And at the moment, I don't know whether the war is going on or not. We just released UFO files, which, if I'm looking at if I'm trying to look past the sale, if I'm trying to look past what Trump's saying, it's because he's not closing the deal. He also has a meeting with China coming up in a week. The 14th to the 16th, I think, is the date. He has a meeting with Xi Jinping. What are they gonna talk about if the war is still going on? What if they still have a blockade? What's that conversation gonna be like? Yeah, we really want to talk about this important stuff, but let's talk about this other crap you get your hands in. That doesn't sound very good. That sounds like a bad deal. So Trump doesn't have much time to wrap this up. And he could claim it's wrapped up, but from what I'm hearing, it's not wrapped up. So you don't have a blockade if it's wrapped up. So yes, he's probably making progress. We have no idea. We just know what he's telling us, which, like I said, dropping the UFO files means that, things are not as good as he's claiming. So I would keep all that in mind. How do you invest with all that information? We've talked about it the last few weeks. The best thing you can do is exercise patience and caution. Who says you have to be in the market? Just wait. Who cares if you miss out on some upside? Wait till it's easy. Wait till there's no brainers. From what I'm seeing in all those sectors, there's not a lot of progress. They're just biding time. If you want to bet on semis and make money there, okay, I'm not going to argue with you. That's the only thing that's really taken off. But besides that, I don't think you're losing out by being in cash. 2 more points. I'm going to give it back to Doug. So one point, and I don't have the chart in front of me, is right now bonds are at a make or break point. Okay. Now, if you look at the 30-year Treasury, the TLT with the ETF marks that, so it's a good way to mark the price. We hit a low like 4 days ago, and then it bounced up sharp, and then it's kind of been biding time. There's a point where the 30-year Treasury is right under 5% right now, and the 10-year I think is somewhere between 4.4 and 4.5. I haven't looked at it this second, but it's somewhere between that. I'll look it up in a minute. But yeah, as of right now, the 10 years around 4.36, and then the 30 years 4.9. So the kind of line in the sand that the bond market's looking at is 4.5 on the 10 year. If it goes beyond there, look out below. If it goes above 5% on the 30 year, look out below. Now, granted, there's not a lot of 30-year bonds out there. Okay, when they stop the 30-year bonds, there's almost none left. So it doesn't really matter, but it's more of a reflection of what the market looks at. So if you look at like the 10-year, the 10-year is, it's is 4.36. It's really at this point where if the war goes on much longer, there will be a lot more inflation. There's a lot more inflation. It means interest rates are going to have to rise. If interest rates rise, we got a tough recession on our hands, and Trump is not going to be favored very highly. All the things he wants to do, he's going to have to pull a lot of rabbits out of the hat to keep that recession off if we go up past that, because you're going to have real estate slowing down, home building slowing down, borrowing slowing down. You're going to have a lot of things slowing down, and that slows down the economy, slows down the markets, and that's not good for stock prices. So when I mean patience and caution, don't get FOMO. Just because the markets are going up, don't get FOMO. Look at the big picture and say, am I willing to take this risk? I want to share this last thing before I move back to Doug, which is, I saw this the other day and I thought it was great. There was a company I get emails from, and they just sent out a bunch of these REITs, and I think they're all REITs. Yeah, these are all REITs. So if you look at this list, these are all private REITs. Some of the names you probably know, some you don't. But I wanted to show there's a lot of commercial real estate in here. So I wanted to show this because there's a big discrepancy here. On the right, there's stated value from the sponsor, and then there's a trading range, which is if you had to trade it in the secondary market, what they're actually priced at. So if you look at, for an example, the Ares Real Estate Income Trust, okay, the stated value from the sponsor is $8.15. Trading range is between 685 and 650. Well, that's a pretty big difference. And granted, these people, the sponsors, I think value them about once a year, so that could be a reason. But if you look at some of these things, oh my God, Moody National REIT 2, the sponsor says $17.25. The trading range is 5 cents to 10 cents. $0. 5 cents to 10 cents. That's a bit of a problem, right? So when you look at, if you're ever investing in like non-traded REITs, and these are not publicly traded REITs, but these are things you'd go to the company direct and they'd give you, investment in it, and it's sexy because, hey, it's cool. I got this cool thing. I personally don't like these things because of the lack of liquidity. In the public market, you can always liquidate instantly. You don't like things, you get out. But I'd be pretty mad if I bought this thing and it went from $17.25 down to 5 cents. I'd be pretty mad. Now, would I want to buy it at 5 or 10 cents? Maybe. Depends on the assets. But if it's trading that low, it's probably worthless. But I will say that here's the silver lining, okay? There are opportunities in here. I don't know where they are. I haven't done the work. But if you're interested, you should. Back in 2009, 10, 11, I saw these things and they were trading for pennies on the dollar. And they were not worth pennies on the dollar, worth a lot more. But everyone just wanted out and they couldn't get out. So they were paying anything. Like, get 10 cents? Fine, take it. I just want something back. And if they just waited, they probably would have got their full money back. Now, I'm not saying that's going to happen in this case, and don't misunderstand me. Some of these are probably worth zero. But if you do your homework and you look through the books and you figure out what things are worth, you can probably pick up some bargains. Because think about it, and I'm not saying you do this, but if you're getting it for 5 cents a share and it's worth 10 cents, you just doubled your money. I'm not saying it's worth anything. If it's worth 5 cents, it's probably worth zero. But if you look at these, it's like $3 and it's claiming it's 11. Well, maybe there's some arbitrage that can be had there. I just say this because most people who are investing in non-traded REITs are not institutional investors. They're not the best and the brightest. They're like individual investors typically. Some of them are smart, but broadly, institutional investors are not buying these. They're buying direct. They're going direct for this stuff. You have $100 million, you're buying direct. You're not buying through a vehicle like this. So just keep in mind that there's probably some value to be had here. And I just shared this because I didn't create it, but I shared this because it just shows such a discrepancy. I mean, look at this. The Terra Secured Income Fund 7, $21,000 a share, and now it's trading between $3,500 and $4,000. I guarantee you could find some value in it. I just don't know where it is. So that's a market you might want to look at. I don't know if it's bottomed out yet in the commercial real estate space, but I can tell you that apparently there's some value in there. And if you can find it, you're going to be very happy. So don't be scared away from real estate. Go do your research, figure out what's a good deal and buy the shares, because if it's a good deal, you'll make a lot of money. If it isn't, well, then don't put all your money in it, right? Be a good investor. Anyway, so go ahead, Doug.
Keep that up for a second, because it very interesting. And I don't know how many of these are still non-traded or how many of these have actually gone. What did you say?
They're all non-traded.
They're all still non-traded. Okay.
This is a private. All
right. So I still I recognize some of these from many, many years ago. And non-traded REITs generally have a liquidation mandate. That doesn't mean they have to hold to it. In about 7 to 10 years. That's their goal. So if you get into them, you have to have patience. They can liquidate, on redemption sooner, but in many cases, but they obviously have the right to control that because they're taking the money and putting it into the ground. Now, the early investors, a lot of their dividend actually, now this may sound like something else, but I'm not getting into it. They get their dividend from the new money coming in, And you really want to look at these closely as to how much of the dividend, how much has actually been put into the ground, because until it's put in the ground, they're literally paying the dividend of the early investors out of cash. This might sound like something else, but it does have regulation that controls that it has to go somewhere. The challenge on these, and this is where I would be very, very cautious right now, is that yes, some of these trading ranges are much lower than the stated value from the sponsor. Now, some of the stated values from the sponsors are still what I would call very inflated, and they have not adjusted, and they have to report under rules that came out in the last decade. They have to do a better job of reporting their what they consider their net asset value. But still, a lot of times that number is overhyped from reality to what the actual current market value would be. Think of the way the local government tells you your house is worth for tax base versus actually what you could sell the house for at a given time. And there can be a big disconnect. Some of these companies have done a better job, and you can tell by the numbers, because usually they start at a $10 par value. So if they're saying that it's $20, they're saying that it's worth well more than they probably started at per share in this. If it's under $10, it means that they've come back and tried to be a little bit more, transparent about what that value might be right now. So some of these you can see are coming in at 5, and some of these are coming in at 1 or 3. They're already telling you there's an issue. Okay. Some of these are showing 11 or 16, and depending on when they got into them, they may truly be worth a lot more, and they've pulled back. And you can see that some of the trading values on them are still over 10, like this Inland Real Estate Income Trust, which I believe focuses more on retail malls, which have probably fared better than your triple net commercial office space. The problem that I have, and the thing I would be most cautious about, is these numbers are before bankruptcies. And if you've seen what's going on right now in the commercial space, you're seeing buildings that have been purchased for $600 million, $300 million that are now going through transactions where the purchase price of the entire building is under 5 million. Some of them, it's close to 1 million. For a 20-story building, that's insane. And at some point, and this is where the values will occur in many cases long term, the value of the real estate itself is worth more than the transaction that's occurring. The problem is, and it goes back to a Warren Buffett, you don't know who's swimming naked till the tide rolls out. And ultimately, it comes down to the value of these entities, the liquidity of these entities to hold on to them. And ultimately, even some of these trading balances may be lower than what they're actually going to be. So even if you get in for the long-term value, unlike what happened with the values and the purchase opportunities in 2010 after the Great Recession, coming out of it, they were great values. We haven't hit that yet. We haven't hit the real implosion. And if that implosion occurs, even if you get in right now, even something that's pricing at 90 cents may be worthless if the actual entity collapses. So this is not an area that I would be spending a lot of time looking at right now. If they do liquidate and go tradable or sell off completely, most of them will probably choose to go tradable. If they do, they're going to probably offer some pretty attractive dividends. Just be very, very careful as you get into that. We've only got about a couple minutes left here. So I did have a couple things. You mentioned something that I wanted to show first, and I'm going to throw this over here, but actually, this isn't the right one, but I will actually, it plays into it. So I'll just click on it again. AI capital spending versus national defense as a percentage of GDP. AI capital spending is actually going to start exceeding defense spending expected by next year. The reason that I'm bringing this up is that right now, this economy that we're in is essentially, as they said here, red hot capex boom carrying everything. AI economy grew at 31% in Q1. Everything else grew at 0.1%. So, when we start seeing the returns of the market, and we've talked about concentration before, you have to be very cognizant of what's driving that. And again, this is where they're already talking about expenditures going down, the amount of cash flow. Kirk, I wanted to bring this up for you because you talked about the bonds really quickly. So I grabbed this one here. The bond market is no longer giving U.S. support, stocks any support. So we've said this before. Watch the bonds. Okay. This is always a critical area where it's telling you a lot of what's going on, again, under the water. And the bond market right now is telling you that the equity market is overheated. The other thing that we're seeing right now is that ultimately, big tech, again, we're noticing, cash flow, booming earnings. Again, we're starting to get earnings that are positive. That's helped drive the boom rate lately. Another chart that I have, and again, I'm not going to show it for time. There, we did start the year with finally seeing what we thought was part of a great rotation, that the rest of the S&P 500 outside of the Mag 7 was starting to perform in line with the Mag 7 stocks, other than, of course, Berkshire, that has really lagged the market by about 30%. Once again, we've seen a complete divergence. And the thing that has driven the market, again, going back to the CapEx of AI over the last month, has strictly been what we've seen the last couple of years. It is Mag 7, it is tech, it is driving everything. But you can see here that their cash is projections. Again, these are projections. So there's a little bit of we always like to look at this as a little bit of a chart crime, because anytime you're predicting where it's going to go, there's always a lot of speculation in there. But they are already seeing a significant dip in cash flow there. Again, I would watch that when we start looking at the returns on AI and the investment and what that means going into the next couple of quarters. Consumer sentiment's fallen. That's something that I wanted to show. The other thing I wanted to show here is that we recently we had Warren Buffett just came out and basically said the stock market is one big gamble, and everybody's just gambling on it. I've got a number of charts. Like I said, I don't have time to show them all right now, but we have seen a massive spike in the number of options and calls that have been placed on the market. So the consumer is basically just trading ad nauseum right now and trying to do everything they can. Another chart is that I have, again, for just sake of time, we've seen cash. I'm going to just go ahead and stop sharing because we're coming up on the hour. But we've seen cash absolutely plummet. So I want to talk about where to invest right now. A couple of things I'm going to run through quickly. Smart money is not investing in the S&P 500 right this second. We're not seeing inflows from them. We're seeing them peel that back. But the consumer, the retail investor, is flooding right into it. Where's the smart money going? We're actually seeing things. And if you're looking at your 401k, this is a risk, because the 401ks that are typically what you have access to is not matching right now where the greatest upside opportunity is. Where is that? There's actually a lot of international investment going on, not Europe. Okay, that's unfortunately where most of the investment that you get access to is. A lot of this is now going towards smaller company investment, international investment. A lot of this is because, again, when you look at the upside to where the current value of investment is, it's not going to be a quick pop, but it has the most room to run upside. That is a big area. We're still seeing a large allocation of gold. In fact, I have a chart that shows China just massively started buying gold again. But at the same time, the number one export for the United States right now is gold. Okay. Another chart that I have shows that mining completely collapsed. Nobody is mining it. So supplies of these commodities and metals and things is diminishing rapidly. So could that be a bullish sign again for seeing a significant spike in commodities? By the way, the other thing, As I said, the retail investor, cash has gone to all-time lows. They've just completely diminished allocation of cash in their portfolios. They're chasing those returns. Smart money's been raising that. They haven't been, they're not selling everything off. They're certainly not panicking, but what they are doing is they are raising cash. And Warren Buffett, again, he's been lagging. We've seen this before in the past where he sits and patiently waiting for things to buy. What smart money's telling you right now, there isn't things to buy. They also look at the latest numbers for the Schiller cyclically adjusted price to earnings. Again, all-time highs, saying that the future returns are looking to be, at least at this point right now, lower. Okay, so what is this telling you? It's not telling you that you should be panicked. It's not telling you you should sell everything and go to cash. But like Kirk was just saying, it is telling you right now, time, if you really want to follow what institutions, what smart money is doing, they are being patient. They are peeling off while others are just going in like crazy. They're peeling off. They're raising cash. They are rotating to things that have higher upside, that are not necessarily in the core investments that you can typically get if you're doing it inside your 401k. So this is where, if I was in my 401k, I would probably be looking at cash as something that is, if you have some access to that. By the way, the jobs report, as bad as it was, healthcare, again, government and healthcare, still some of the biggest hiring areas, which is all not necessarily bullish for the economy. And service, so from that standpoint, again, with limited access, I would probably say that cash is going to be your friend, as well as potentially, shorter term bond yield, where you can get good interest rates, but still peel off of it, less volatility. We're definitely seeing more movement to value. We continue to see that on the smart money side. Again, retail, not at all. It's let's trade the options. Let's go all in. AI's everything. To me, that's a huge risk. So anyway, to wrap things up for today, the economy is still moving, but it is not moving evenly. Housing, another chart that I showed, absolutely one of the worst years for starts for transactions. We've seen some things picking up, but it's not been a good year, and nobody's probably expecting that. We're seeing mortgage rates go back up. That's going to be bearish in certain areas, still positive, but overall, I have another chart that shows that housing could be 30% overinflated in pricing based on in many areas. So that's certainly something to watch. Consumers, not retail investors, but consumers are becoming selective. They are getting squeezed. By the way, if you're already seeing high utility prices, the amount of gas that they are predicting to be needed for data centers, it's going to put more pressure on the pricing of the commodities that you need just to run your home. Thank goodness we're going into summer where gas usage in homes will be lesser, but certainly a concern going into next winter. Rates are still restrictive. Bond market remains very cautious. By the way, there's another chart showing how much Japan has been spending and selling treasuries just to uphold the yen. Things to talk about later. So markets continue to push higher. Confidence is concentrated in small themes, AI, megatech, and belief that liquidity eventually wins. And this may work for a while, but concentrated markets create concentrated risks. So at Mergent Advisors, we help families cut through that noise by mapping everything: income, assets, liabilities, taxes, college planning, funding, cash flow, retirement income, so that your plan doesn't depend on one narrow market narrative staying completely intact, because clarity matters most when confidence gets crowded. If you want to understand where you actually stand, visit us at mergentadvisors.net, MERGENT, mergentadvisors.net, and start the conversation. And thank you for joining us. We'll see you next time.
Awesome. Well, thanks, Doug. Thanks for joining us.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel. for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.